Hi, Bill Bodner here, Mortgage Market Guide. Thanks for tuning in to our MMG Weekly Recap. So up on the screen, some good news came out on Thursday that mortgage rates had their biggest one-week drop in a decade, and that coincided with that breakout. We've been talking about how the 10-year note has seen support at 260. Goodness, when the yield finally punched through 260, we were seeing 230s in the middle of the week. Pretty remarkable. And it's something we've seen over and over when these barriers are broken, how bonds can really take off. And so that's what happened this past week. And so really interesting. And I think, some of the fuel to this, decline in rates and raise in price was this economic slowdown that's not only a concern abroad, well documented what's going on in Europe and negative yields in Germany. I mean, Germany's 10-year Bund is yielding, beneath zero, which is just really remarkable. But, some of that slowdown even kind of showing here in the United States. And so what was the real catalyst was that in the middle of the week, Stephen Moore, who's been nominated to the Federal Reserve Board, said if he gets on the Fed, he's going to vote to cut rates by 50 basis points. Which is pretty remarkable and a real departure from where the Fed was just last year. You may recall back in the fall, there was a lot of volatility, right? Where the stock market was declining significantly. The bond market was kind of rallying a little bit on that because the Fed said, hey, we're going to hike rates 3 times in 2019, regardless of what the data shows. And so, boy, did they back off of that. So in 2019, not only are they not hiking rates in 2019, they came out and said that, but now there's a 75% chance they will actually cut rates this year, which is just remarkable and just shows the change, how things change and why you need to be watching this stuff closely because it does move. It's very, very fluid. Looking at the bond page, heading into the weekend, you could see here prices, this is the breakout. We were having a tough time at these ceilings. We broke out above it, and this doesn't look like much in a 2-year chart, but that's a pretty material price move, and that's why we've seen the sharpest decline in rates in a decade because it was a breakout above a ceiling. So now prices are testing areas we haven't seen in 14 months, which is beautiful. And so, but we can't, we know it's been complacent, the market. Things have been, kind of calm, right? The Fed is, higher interest rates is not a threat. Inflation is not a threat. The Fed hiking rates is not a threat, so there's a lot of complacency, especially in the bond market, but that can change quickly. It's almost like a rubber band being wound tight. Eventually, it kind of snaps, so we need to watch, especially after a rally in bond market, an extended bond market rally. There can be a turnaround, and it can reverse quickly. And so there are some headline risk events happening this week that you need to be mindful of coming up this coming week that you need to be thinking about. Number one, we got retail sales Monday, so right out of the gate, retail sales comes up. But then you can see here up on the screen, we have the Bureau of Labor Statistics. They report the jobs report next Friday. Now, the previous jobs report was a stinker, only 20,000 jobs created. You could probably get a good bet that will be upgraded or it will be revised higher. But there are some other readings within the report that can create a negative surprise that bonds can react to. So floating a little bit more dangerous. So one is hourly earnings. Hourly earnings are currently running at 3.4% year over year, the highest in a decade. If that ticks up higher because of this tight labor market we're seeing, the bond market may react negatively to that. So we need to watch that one carefully. And so I hope this helps you. Hope you're having a great weekend, and we'll be back at it soon. Have a great one. Bye for now.